everyone, welcome back. In this video, we are going to talk about deductions from AGI. So once we get our gross income, subtract our 4 AGI deductions, and then get AGI, the next step in the tax return is looking at deductions from AGI. And these are also referred to as below the line deductions, that line being AGI. And so in this particular video, the deductions from AGI we will be talking about are the itemized deductions and the standard deductions, because these two, itemized and standard, they are compared against each other to see which one is higher. And then ultimately, as the taxpayer, you would want to select whichever one is higher, because that will produce the greatest benefit for your tax situation. So let's look at the itemized deductions first, because those are a little more extensive. There are a lot of different things that can qualify as an itemized deduction. And so for each item, since we have a lot of information, I am going to touch on the key pieces of information to keep in mind as you're looking at practice problems, looking at homework problems, and looking at problems on an exam in the future. Wink, wink, nudge, nudge. So the first area where we will start is the medical expenses. So for medical expenses, taxpayers may deduct medical expenses incurred to treat themselves, their spouse, and their dependents. Qualifying medical expenses include unreimbursed payments for care, prevention, diagnosis, or cure of injury, disease, or bodily function. Along with that, taxpayers using their personal automobiles for medical transportation purposes may deduct a standard mileage allowance of 21 cents per mile in 2025 in lieu of actual costs. In terms of medical expenses that can be included for this deduction, taxpayers may deduct the costs of actual medical care, whether the care is provided at hospitals or other long-term care facilities. It is also important to note that the medical expenses deduction does have a limitation, and this is limited to the amount of unreimbursed qualified medical expenses paid during the year, no matter when the services were provided, reduced by 7.5% of the taxpayer's AGI. So I'm going to add a couple of notes for things out here. So we want things that are unreimbursed. Make that look more like a U. There we go. Unreimbursed. And then we have a 7.5% AGI floor. Moving on to taxes. Individuals may deduct itemized deductions payments for the following taxes. So they can deduct their state, local, and foreign income taxes, state and local real estate taxes on property held for personal or investment purposes, state and local personal property taxes that are assessed on the value of specific property. And then there is an option for a sales tax deduction. So state and local sales taxes can be deducted in lieu of state and local income taxes. And so where that could be more beneficial to a taxpayer is if a taxpayer lives in a state that doesn't have an individual state income tax. Additionally, under the taxes topic, the One Big Beautiful Bill Act, enacted in 2025, limits the total itemized deduction for state and local taxes to $40,000 or $20,000 for a taxpayer filing married separate. The itemized deduction for foreign income taxes is not subject to this limit. The $40,000 state and local tax deduction cap, or $20,000 if you're a taxpayer married filing separate, that cap is reduced by 30% of the excess of the taxpayer's modified AGI over the phase-out threshold. So in 2025, that phase-out threshold is $500,000, or it is $250,000 for taxpayers married filing separately. However, that cap is not reduced below $10,000 or $5,000 for taxpayers married filing separately. So, state, local income, real estate, personal property, or sales tax, and then limit $40,000. For interest, there are two types of interest expense that can be itemized. The first one is the deduction of investment interest expense. And that deduction of investment interest is limited to the taxpayer's net investment income. And for that type of interest expense, any investment interest in excess of the net investment income limitation can carry forward to the subsequent year. The other type of interest expense that can be itemized is for home mortgages. The important thing to keep in mind here is the timing of when that indebtedness or the loan was incurred. So if the loan was incurred before December 16th, 2017, the taxpayers may only deduct mortgage interest on up to $1 million of acquisition indebtedness. If the debt was incurred after December 15th, 2017, then the taxpayer may only deduct mortgage interest on up to $750,000 of acquisition indebtedness. So investment or home mortgage, investments, excess can be carried forward. And then for home mortgages, remember the date 12/16/17. Our last larger category of itemized deductions is charitable contributions. Whenever we're thinking about what a charitable contribution is, it is a contribution of money or property that must be made to a qualified domestic charity. Additionally, qualified charitable organizations include organizations engaged in educational, religious, scientific, governmental, and other public activities. And on that government piece, it's important to note that contributions to political campaigns are not deductible. Additionally, there are special rules that apply to charitable contributions of property depending on the type of property. So on page 5, there is a table that talks about how to go through the steps to determine how much you can deduct for charitable contributions. And the different types of contribution types we have are cash, capital gain property, and ordinary income property. So cash is just like what it sounds, it's cash. Capital gain property is related to investment assets like stocks, bonds, land, paintings. It could be business assets or personal use assets. And another distinguisher for capital gain property is that those items are typically held for longer than a year. Ordinary income property, on the other hand, are items that are typically held for a year or less. So an example of that type of item could be inventory. So for the charitable contributions note, I'm gonna say see page 5. Of tax rate packet. Then some other itemized deductions that could pop up. So items that are not deductible, if you were to see any of these items in a fact pattern. So items that are not deductible include unreimbursed employee business expenses, tax preparation fees, investment expenses, and hobby expenses. Other itemized deductions that are deductible include gambling losses and expenses to the extent of gambling winnings, so there's a little caveat there, casualty and theft losses on investment property, and unrecovered costs of a life annuity at death. All right, now that we've made it through the itemized deductions, we can talk about the standard deductions. So these standard deduction amounts, you do not have to memorize them. In fact, they are included on page 2 of the tax rate packet. So page 2 of, oh my gosh, I can't close my A's, there we go, of tax rate. And so these standard deductions are based on your filing status. There are additional standard deductions for age and or blindness as of the end of the year. And then it is also important to keep in mind that for individuals claimed as a dependent on someone else's return. So like, let's say a teenager who just started their first summer job, their parents may still be claiming them as a dependent on their tax return. So for individuals like that, as an example, the 2025 standard deduction for that individual is the greater of $1,350 or $450 plus earned income not to exceed the standard deduction amount of those who are not dependents. In the previous slide, we talked about how the itemized deductions and the standard deduction are compared to see which number is higher for the taxpayer. And whichever number is higher is the one that the taxpayer would want to select, because that would be the most beneficial for their tax situation. Ways to help make itemized deductions higher than the standard could be implementing some of the timing strategies that we discussed all the way back in chapter 3. And this actually happened quite a bit frequently, I think before the standard deductions increased with the Tax Cuts and Jobs Act. But I remember when I was taking my tax class, I had learned that one of the reasons why charitable giving is so high in the month of December is because it's actually used as a tax planning strategy. So me, when I was in school being young and naive, I was like, oh, it's Christmas time, everyone's being generous and giving. To a certain degree, that is partially true. But it is also a tax planning strategy for taxpayers. So if they're going throughout the year and doing their tax planning and they see like, oh, it's possible like they may owe, a piece of advice that a CPA might give to their taxpayer is, hey, let's boost up your charitable contributions at the end of the year so that way your itemized deductions get pushed up to be higher than the standard, and then that would create a more beneficial tax situation for you. So perfect example right there of how timing strategies can help with tax planning. And that is it for this video, and I will see you in the next one.